Hello, my name is Vicky Hughes and I'm Director of Private Client Services at Brown Butler Chartered Accountants in Leeds. Today, I'm going to talk to you about HMRC's Trust Register and more specifically, the expansion of its scope. This means trusts with no tax liability now need to consider whether they have an obligation to register by the 1st of September 2022. Let's start by talking about what will be covered in this session. We'll have an overview of the Trust Register, an explanation of registerable express trusts. We'll look at exclusions that can apply provided the trusts are not taxable. We'll then look at scenarios that are likely to be caught and which may come as a surprise. And we'll finish off with some reminders and tips. So what is the Trust Register? HMRC's Trust Register has been in place since the 2016-17 tax year and has meant that trustees of certain trusts have had to register it online using the Trust Registration Service. They've had to keep that information updated and do annual declarations where the trust has been taxable. So the trusts that have been caught have had tax liabilities, and the tax liability has been one or more of income tax, capital gains tax, inheritance tax, stamp duty land tax, Scottish land and buildings tax, Welsh land transaction tax, or stamp duty reserve tax. These are now known as registerable taxable trusts, and there are special rules that apply to them. It's a way trustees must provide information on the trust to meet anti-money laundering obligations. Under the 5th Money Laundering Directive, the scope of HMRC's Trust Registration Service has been significantly expanded and now includes a greater number of trusts, and in particular those that are non-taxable. The deadline for adding additional trusts is the 1st of September 2022, and so this needs addressing as a matter of urgency. In this session, we're focusing on registerable express trusts, so those are the trusts that do not have a tax liability. The deadlines to be aware of for these non-taxable trusts are as follows. If they were in existence on or after the 6th of October 2020, they need to register by the 1st of September 2022 or within 90 days of creation if that happens to be later. Changes to trust details or circumstances also need to be made, and they have to be reflected on the trust register within 90 days of the changes arising. The main changes in the scope of the Trust Register are that all UK Express trusts will have to register whether or not they have tax liabilities unless they're an excluded trust. Trusts which are already registered will have to provide additional information. For example, this could arise where you had a trust that was a taxable trust, but then it was non-taxable, and the information required now is more than was initially entered. Non-UK Express trusts also have to consider if they're required to register unless they're excluded. So they're likely to need to go on the register if they acquire an interest in land in the UK, or they enter into a business relationship with a relevant person where at least one of the trustees is resident in the UK and the trust is not an EEA registered trust. Third parties will be able to access some of the information on the register, but there are strict controls in place. Also, penalties may be imposed if entries are not completed. So, some scenarios are excluded, provided the trust is not taxable. These include trusts used to hold money or assets of a UK registered pension scheme, so for example, an occupational pension scheme. Trusts used to hold life or retirement policies, providing the policy only pays out on death, terminal or critical illness or permanent disablement, or to meet the healthcare costs of the person assured. Also excluded are trusts holding insurance policy benefits received after the death of the person assured, provided the benefits are paid out from the trust within 2 years of death. Charitable trusts which are registered as a charity in the UK or which are not required to register as a charity are excluded, as are pilot trusts that were set up before 6th of October 2022, provided they hold no more than £100. Child bank or building society deposit accounts are excluded. This is whilst the child is under 18. So if for any reason an adult continues to have authority as bare trustee over that account, they would then need to go on the trust register. Child trust funds are excluded, as are junior ISAs. In the case of junior ISAs, this is a recent update that was made to the trust register guidance in April 2022 and is a very welcome clarification from HMRC. Other situations that are excluded, provided they are not taxable trusts, are co-ownership trusts set up to hold shares or property or other assets that are jointly owned by 2 or more people for themselves as tenants in common. Will trusts that are created by a person's will and come into effect on their death, providing they only hold the estate assets for up to 2 years after the person's death, are excluded, as are trusts for bereaved children under 18 or adults aged 18 to 25 set up under the will or intestacy of a deceased parent or the Criminal Injuries Compensation Scheme. Financial trusts created in the course of professional services or business transactions for holding client money or other assets are excluded, as are trusts imposed by court order, but please beware that a separation agreement does not meet the requirements. So now we're moving on to scenarios that are likely to be caught and which may come as a surprise to you. Bare trusts do need to go on the trust register unless they fall within one of the exclusions. Trust holding investment bonds would usually have to go on, as would discounted gift trusts. Pilot trusts set up to receive pension, death benefits and life insurance would need to go on there, but where they were set up before the 6th of October 2020, they would only need entering on the register where the value of the trust is more than £100. All new pilot trusts set up since the 6th of October 2020 need to go on regardless of their value. Other situations that are likely to be caught are co-ownership trusts, such as declarations of trust over property, where the trustees and beneficiaries are not identical. Situations caught here would include scenarios where the number of trustees differs from the number of beneficiaries. So situations where you have minor beneficiaries would be impacted as they cannot be trustees. Also, where property is jointly owned, particular care is needed, and you could in fact have 2 trust return manual entries that are required. The will trust and the trust of property held by the owners of the legal title. On the 18th of March 2022, there was an update to the Trust Register Manual, which gives examples. This is TRSM 23020. Employee benefit trusts and employee ownership trusts are not exempt, and so those in existence on or after the 6th of October 2020 must be registered by the 1st of September 2022, including those that have already been distributed. Trusts wound up in the period between the 6th of October 2022 and the 1st of September 2022 also need to go on there unless they fall within one of the exclusions. Now, for some reminders, it's important to update clients and help them assess whether they're impacted. Awareness of the rules is patchy. For those trusted to court, i.e. they're not specifically excluded, you go back indefinitely in time. Depending on the situation, you could find yourself with a situation where you've got a trust that switches between the registerable taxable trust rules and the registerable express trust rules. Both are within the same register, but there are differences in the questions that need to be answered and the obligations met. Significant information is required, and obtaining that information could be hard. This could cover obtaining information on all potential beneficiaries, including those discussed in Letter of Wishes, and family estrangements could impact the ability to get the information you need. There are questions that need to be answered regarding mental capacity. If you respond that the individual does not have mental capacity, then they wouldn't be contacted by HMRC with any queries. Now for some tips. Gather all the information you need first, because partly completed entries are only retained for 30 days before being automatically deleted. If national insurance and date of birth records don't tie up, you won't be able to proceed, and you would need to liaise with HMRC to correct the underlying records. The Trust Register Manual has guidance and technical detail. This is being updated regularly and the examples expanded, so keep an eye on that. You only need one exclusion to apply to prevent the need to register a non-taxable trust, but a large amount of scenarios are caught, and you need to read and apply the exclusions carefully. Beware of letting this fall between different advisors who are assisting the same client, because you could get a situation where no one actually completes or discusses what's required. It will take time, and so additional fees will need to be considered. Issues to address will include scenarios where there are no liquid funds in the trust or no ongoing file or contact. For older files, consider internal policies and how you're going to deal with specific scenarios. Do let us know if we can be of further help. Here is my direct dial and email address. I wish you well with helping your clients understand these obligations. Thank you.